Let's go to the World Economic Forum again. It's in Davos in Switzerland, and my goodness, that Nozipho Mbanjwa's been busy, really getting money's worth out of her. She caught up now with Gavin Wilson, the CEO of IFC Asset Management at the WEF, to discuss global investment flows. Here's that conversation.
Our role is to mobilize commercial capital into developing markets. The IFC invests about $18 billion of its own capital in emerging markets every year, and one of our mandates is to mobilize additional capital beyond our own balance sheet. So what we've done with the asset management company is set up a platform for raising money from commercial investors, sovereign wealth funds, pension funds, people like that, to invest with us in emerging markets, fund by fund, sector by region. Each fund has a specific purpose, but the overall objective is to mobilize additional capital in a way that is commercial, that generates an appropriate risk-adjusted return and proves the fact that actually investing in emerging markets can be very profitable.
Is the appetite for emerging markets still there, given the changing global or economic order?
Actually, if anything, it's more pronounced. Although a lot of the conversation this week has been about the euro and the eurozone, I think there is now a sort of conventional wisdom that emerging markets are indeed the growth engine, and that opportunities for productive capital investment exist predominantly in the emerging markets, which now constitute 55% of global GDP.
Closer to the African context in particular, many of the African leaders that I've had the opportunity to speak with all highlight infrastructure as the key enabler for sustained growth. To what extent is there appetite to invest in Africa's infrastructural dreams?
Well, first of all, there's a lot of appetite to invest in Africa. We invested, I think, about $3.5 billion ourselves last year. We mobilized another $1.2 billion. About $1.1 billion of that was infrastructure, so maybe about a third. I think that's fairly typical for us across the world. Infrastructure is, in many cases, a key bottleneck, both for public sector and private sector activity. Now, it's always been difficult promoting private sector investment in infrastructure, even in developed markets. So this is a global issue. It's something we've worked on a lot. In fact, a number of the conversations we've been having here in Davos this week have been about how do you promote long-term institutional investment into infrastructure assets. We've got some good examples. We've invested recently in power plants in Cote d'Ivoire, in wind farm in Tanzania, railroad in Kenya, Uganda. So there are a number of places where we're able to invest, and other investors are happy to invest alongside us. But infrastructure is obviously, by definition, a long-term play. And so therefore it requires a slightly different mindset from our institutional co-investors.
What kind of conversations then are you having with African leaders who've made the trip to Davos? Because no doubt you're also looking for policy coordination where there are projects that are multi-jurisdictional falling in more than one country.
Yes, and one of the benefits of Davos is the ability to sort of see the big picture and not necessarily get focused on specific transactions. But I think the common theme is, how does one reduce risk perception? Okay, it's actually quite expensive to reduce real risk, but it's not all that expensive to reduce risk perception. And there are a number of things that governments can do, and this is not unique to Africa, by the way, but there are a number of things governments can do to make investors more comfortable with the rule of law, government covenants on various, take or pay purchase agreements, where if it's a power plant, for instance. I mean, these regulatory sort of environment in which long-term investors invest is terribly important. And by the way, what one government does in one particular country can have an impact on the perception of risk across the whole region. It's not just within that country. So I think I wouldn't necessarily call it coordination, but there is actually a collective impulse, a collective benefit in getting this right.
As a final question, let's just get our pulse on where Africa's risk radar is, if I may put it like that. There has been a perception that Africa has improved drastically, both in terms of law and order, governance, democracy, and all of those beautiful things. But we've had a bit of a slip back with the outbreak of Ebola and some of the terror attacks. Where do we stand now? Are investors sufficiently threatened by these developments, or they still have their eyes on the bigger picture?
Well, Ebola obviously is a huge problem. We mobilized a very rapid response to that, along with our colleagues in the rest of the World Bank Group. We've got a recovery program underway, and then there's sort of long-term investment in the countries affected. So it's a relief that it has not spread further, but there's still a lot of work to do to make sure we contain the existing crisis. Clearly, that's not good for long-term investment. There are more fundamental economic issues beyond the health issues that need to be addressed. But that doesn't alter our long-term perspective on Africa as a continent in which we would like to invest more, encourage others to invest more over the years ahead.